Good afternoon, traders. This is Bob Haberkorn, coming from RJO Futures on Tuesday, May 28th, here in the afternoon. Here to discuss with you the GDP numbers, the second estimate that comes out Thursday morning at 7:30 Central. I'm here with Jeff Friedman and with John Caruso. Expectations right now, again, it's the second estimate of the first quarter GDP. They're expecting it to come in at 2.5%. That's what it was last go around. So, we'll see how it plays out. Not expecting too many fireworks off this number. Usually second estimates kind of stick within line. Jeff, what are you looking at? What are your thoughts here for Thursday morning?
I think it's going to probably come in line. If it's dramatically negative, in my opinion, it probably bad news is good and good news is good. I think the dominant situation here is central banks. I mean, last week we saw the stock market futures pull back a little bit. People were saying maybe we're way over because they're going to pull back, and it being up 16 or 17%, depending if you're looking at the Dow, the Nasdaq, or the S&P. And right away they kind of, hey, let's maybe take profits and this and that. And then here we are Tuesday morning or Tuesday midday, we're up a lot. Japan committed more over the weekend to central bank stimulus. Europe said, the ECB said that they could cut rates even more. Coming in, we were up 10 points. We went up 20 points. We're back down. I think you got to look at the technicals. Give you an example in the S&P. We're up 16 to 17% for the year. A lot of people are looking at some of the chart patterns, resistance that we kind of couldn't seem to get through the first time around or the second time around. Would be probably 1675 in the June contract S&P. Your next level might be 1684 as a resistance level. And I think a lot of chart people are looking at around 1690. On the way down, we had a very minor pullback on some bad news before, and it looked like 1630 held, 1632. I think a close underneath that would have people talk about the 1620. A close under that would change direction of this huge bull market. In my opinion, it's fed by not GDP. It's not fed by weak manufacturers, which we saw last week. It's not fed by housing starts that we saw today. It's not going to be fed by consumer confidence all that much. It's really how much money on the QE3, QE4, central banks in Japan, central banks in Europe, and in America. And my opinion is that until we have some technical damage or we have a transparent deadline on when they're going to pull back and how severe they'll pull back will be the movement in the market in the stock index. And I think there's a lot of people chasing yields, trying to get on board, trying to get their quarterlies in good standings, and they've missed part of the rally and now they're chasing. So I think that's what's driving it, and I don't think GDP on an estimate like you mentioned is going to change anything at all, unless they came out with a 1.0 or something like that, something very dramatic.
Right. But with the way, even if it does miss and comes out at a 1.0, if it did that, the stocks probably would pull back, a bit. And with the central bank,
it'd be buy the dip.
Buy the dip.
Right.
I mean, this is central bank. The rally, what we're seeing, is all being driven by central banks, quantitative easing. I don't think there's any question about that right now. And there is, like you said, a lot of chasing going on right now of people that feel like they're late to the party in these equities. So the number Thursday, we'll see what it comes out like, 2.5 expectations, but,
I think we're coming in below expectations. I think economic activity did slow down. I think that is true when you take a look at some of the manufacturing numbers that we've seen. Jobs have picked up and all that, but I think we're going to come in, I think we're going to miss expectations. Market will pull back for a little bit. But I think we'll probably hold support down around 1632 until next week's unemployment number. So I think that's what it all comes down to, is next week's unemployment number. The Feds have put a target on unemployment at 6.5%. They're going to be there until we see that rate come down to 6.5%. Also, Bernanke mentioned last week that they're going to take a look at the next couple of Fed meetings, and that's what the market didn't like. That's why we pulled back. we do get some positive numbers and positive readings between now and the next, say, the July meeting, you could see the market catch edge, get a little edgy, that they're going to be pulling off a little bit earlier than expected. But I think when you look at it, I think we are in the 9th inning of this QE program. I don't know how much longer they're going to be in there. Maybe some people, I know CNBC's predicting until September. So, I guess we're gonna find out what all these numbers between now and then come out and look like. So.
Yeah, I mean, until they set something finite, something definite of when they are going to end the program, which I don't see it coming even in September. I'm looking even further out right now with the way things are going. I think they got to keep fueling the fire to keep this move going, and keep numbers like what we're going to see tomorrow, the GDP number up. I think without the Fed and without central banks, we'd see some pretty anemic numbers.
Right.
For gold and silver right now, expect that to probably continue to do the same on what it's been doing here. Gold right now is trading up on the day. It was positive, up about $5 as of this video time, where it was down throughout the day, had a big short covering rally, it looked like. But commitment to trader reports continue to come out week after week now that are showing net positions declining for the larger scale investors. So, I think there's still some pressure definitely in the precious metal markets, but not to say that won't present a buying opportunity here at some point. I think it'll be later on as the summer goes on, because we're also in the seasonality of the gold silver market, where it typically has slower months in the early summer up through July. So anticipate some more pullbacks in that. Granted, nothing geopolitical happens, but I think after that, investors will start taking a look after the summer starts coming to an end, more so in the precious metals. The bulls will, for that matter. But definitely a lot of bears out there on the street. But keep an eye on it. If you have any questions, please feel free to contact any of us. We can discuss any of these markets further, more in depth with you. Remember to follow us on Facebook and on Twitter. Remember, futures trader does pose significant risk, is not suitable for all investors.